All right, options traders, back with another video. Today I'm going to be covering a trade that we did in the chat room, and that was calendars in QS. We had the short 28 calls for September 24th and long 28 calls for October 1st, and we got each of these calendars for a 25-cent debit. Now, typically I don't play calendars. This strategy is in my arsenal, but for myself and other traders in my crew, when it comes to calendars, there's a specific time and place for them, and the stars aligned here. Many play calendars with 25 to 50% profit targets. I typically trade them with 200 to 300% targets in mind, as with many other spreads we play. For calendars, I like to treat them as basically like funded YOLOs. Now, a couple of reasons why we got into this trade. First was the debit risk was cheap enough compared to the potential reward. And the second was I'm a very technical trader and the technicals lined up. Stock was in a squeeze and broke out above all the moving averages on decent volume. We also had the buy signal from my swing indicator confirm. And typically when all these signals line up, I'm more willing to bet on YOLO type plays, which means I'm willing to drop a reasonable debit on cheap out of money calendars. Another reason these calendar prices were a bit favorable was that Ivy was starting to get pumped. Typically when that happens, the difference in value between the near and further dated out of the money legs gets a bit narrower. So we got a bunch of these calendars for 25 cents each, and I told my brewers, hey, if this stock runs again tomorrow, they should double. Now, it didn't run $2 to $3 higher the next day. It just paused and traded sideways, which is actually good. From an options pricing standpoint, the short 28 call would just drain more, while the long 28 call would still stay bid. From a technical analysis standpoint, it just means that pressure is building up for the next leg higher if the breakout happens, which means the calendar would expand. And it did. On Thursday, we broke out again, and QS moved almost $4 higher. Our calendar started to expand, and we took some off at 59 cents, 69 cents. Some took them off for 72 cents. Overall, people were happy and they were learning not just how calendars worked, but also how we like to play calendars in this low debit, high payout approach. One thing to note is that during all this time, the short 28 call couldn't really rise much in value because it only had 1 day till expiration, so it was experiencing that decay even though QS moved up huge. Meanwhile, the long 28 call pumped and remained bid because it still had an extra week of time, so we were sitting comfortably on these calendars knowing that theta was in our favor. Given the large decay happening in the short call, we knew that on Friday, if QS stayed where it was near Thursday's close around $27 to $28, the short 28 call would basically fall flat on its face and the spread would expand even more. A lot of what gets factored into the extrinsic for these 1 to 0 DTE is the overnight risk, but it quickly drains if no gap occurs by the next session. So we had more of these calendars going into Friday. By Friday open, as QS hovered around $27 to $28, these spreads expanded to north of $1.10 or about plus 340%. Now, I personally didn't nail that high, but I closed all remaining but one calendar at about 80 to 85 cents each. Now, why did I leave just one calendar? It wasn't to take it into expiration and milk the theta from the short call. It was to get paid a little bit more to play the coin flip for next week. What do I mean by that? Well, recall that the short 28 call expires on September 24th, while the long 28 call expires on October 1st. On Friday, that short 28 call was basically worth pennies and had close to zero value. So essentially what I'm left with is just a long October 1st call. But instead of taking everything off, I decided, hey, what if QS runs again next week? I could close the September 24th 28 call for pennies, keep the long call, or better yet, close the short call and short to open the further out of the money October 1st 34 call for more credit and further reduce cost. So I rolled the short 28 call up and out to the 34 strike for October 1st, netting an additional 18-cent credit. So I got paid a bit to perform this adjustment. And now I'm left with a $6 wide 28.34 long call vertical going into next week for the potential of netting another $6 in credit. Remember, the max value of the vertical is $6. If QS does happen to continue running higher next week, that's great. I can flip the vertical out for more credit. But if not, I'm willing to close out whatever value is left in this vertical. No harm, no foul. After all of the cost and then some had already been harvested back via scaling out many of the calendar pieces at around plus 200%. So we'll see what happens this coming week. So that's a breakdown of the QS calendar trade that I did recently with my crew. Again, I don't always trade calendars, but when I do, I try to make sure that the risk reward is worth it. If you thought this was educational and you want to learn more about low debit, high payout spreads, come check us out and trade with us in our Discord chat room. Links in the description below. We put on a lot of spreads. You can pick and choose which one you're interested in and get updates on that. Learn about how spreads work, what exactly myself and other brewers are thinking when we enter trades, why we pick the spread, what strikes, what expiration, all of that, how we manage manage the trade as it progresses over time, etc. I also put out nightly trade ideas with the exact spread, strikes, and expiration, and weekly trade reviews, all for educational purposes. And I do this just so that you can really build up that intuition needed for sniping these types of high return trades on your own, rather than trying to YOLO everything and seeing what sticks, or mechanically selling premium till the train runs you over. But that'll do it for this video. I'll see you guys in the next one. Cheers.